January was a very rough month for the market with a major tech sell-off that pulled the rest of the market down with it. I'm Seth Freuberg, the head trader of SMB Capital's options trading desk here in Manhattan, and professional traders know that sell-offs like the one that just happened in January are inevitable and constitute major trading opportunities if you're prepared. So if you're interested in how to get prepared for the next market sell-off and how to lock in your profits once it takes place, then stick around because I think you're going to find this useful. Hi, I'm Seth Freuberg, and I'm the head trader of SMB Capital's options trading desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. So I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really valuable. Okay, so I'm pretty sure that investors and traders with a long bias are happy that the month of January 2022 is over, with tech stocks dropping as much as 17% at one point during the month, which pulled the rest of the market down with it, with the broader S&P 500 index dropping more than 12% from its early month highs as well. And experienced traders understand that for every rally, there's an inevitable sell-off that follows, sometimes into the 10% correction territory, and sometimes it goes even further into a flat-out bear market when the sell-off exceeds 20%. And so these inevitable facts give rise to really great trading opportunities if you position yourself correctly, and even more, once these trades start working for you, there are ways of locking down the profits that put you into a literal no-lose position where you can benefit whether the market goes up or down once you make one particular move that puts you into the driver's seat. Now, before we get into exactly how this trade, which takes advantage of market sell-offs, works, I'd like to let you know that if you want to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, or the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That will open the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. All right, so in order to explain how this trade works, we need to make sure people watching the video understand how put options on indexes work. And for those of you who already know how they work, this is going to be really quick, and then we'll jump right back into the strategy. The best way to understand put options on indexes is to think of them as bets that the market will go down. The put buyer pays to the put seller what's known as a premium to make this bet, and the put seller is the one who is taking the bet and receiving the premium for taking that bet. The put option bet pays off if an index closes below what's known as the strike price of the put option on the day that the put option expires. If the index does close below that price on expiration day, then the put buyer receives $100 per point that the market closes below that put strike price. So for example, if an index closed at, say, 40.32 on the day a put option expires, then the 40.75 put would be worth $4,300 because the market closed 43 points below that put's strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. Okay, so keeping that in mind, I'd like to bring up an illustration from the past which could have been just as applicable to taking advantage of this recent January sell-off, incidentally. And so going back to the final quarter of 2018, you'll see that the market had been going through a sustained sell-off followed by a few mild bounces. The market was in the middle of one of those bounces on November 30th. And so there are traders who would take a look at this chart and they may see the likelihood of another leg down before this is all over. And so let's say that on that final day of November, a trader were to buy 4 of those 2750 put options expiring in mid-January, which are located right below SPX's price of 2757 on that day. And as you can see from the calculation, the puts cost $61.20, but remember, each put represents a $100 payment for each point below 2750 that the index expires on expiration day. And so you multiply that by 100 and the trader buys 4 of them. So multiplying it all out, the initial cost of this options position is $24,480. And so let's now move into December. And as you can see, the sell-off continued, and by December 14th, the market had made a lower low in classic bearish market fashion, having sold off to 2602, and so that's when the trader can get into the driver's seat with the following move, and that is to sell 4 puts down at 2610, which he's able to sell for 65.05 that day. Now let's take a look at what that means cash flow wise. And as you can see, if he sells those 4 puts at 2610, he brings in $26,010. And when you compare that to the 24,480 that he paid buying the original 4 puts, it turns out he now has positive cash flow from the campaign. Now, why is that crucially important? And the answer is that now that the position is positive cash flow, there's no risk left in the trade. Why? Well, think about it. If the market were to close above 2750 on the day the options expire, then both of those puts have no value, obviously, and so the trader just pockets the positive cash flow of over $1,500. If the market closes anywhere from 2610 up to 2750, then the 2610 options expire worthless, and the trader can cash in on the 2750 puts, which will have value below any close of 2750 or lower, plus he adds that positive cash flow of over $1,500 to his profits. Finally, if the market closes below the 2610 puts, then he'll have to start paying out under the 2610 puts, no doubt, that he sold, but whatever he'll pay will be way less than what he will receive for the 2750s, because those would be worth a fortune in that they started paying off at 2750 and keep paying off more and more as the closing price gets lower and lower. And of course, you add in again the positive cash flow to finish the profit picture. And so under any scenario, the trade now can't lose at this point. Okay, so next, let's move to December 18th. And as you can see, the market has fallen again down to 25.46. And so at that point, what many traders would do would be to lock down even more guaranteed profit by closing half of the position. And as you can see, after taking into consideration that $1,540 of original cash flow and adding over $41,000 that you get for cashing in just 2 of those 2750s and paying $19,920 to buy back the 2 2610s, your guaranteed profit on the trade has now increased to $23,390, because again, the worst case scenario is that those 2 puts expire worthless, while the cash flow already collected in excess of $23,000 now gets pocketed by the trader. And so at this point, the scaled back position looks like this, with 2 options at each location. Okay, so now let's move to expiration day, and as you can see, the market had begun to bounce, so that by the day the options expired, the SPX was back up at 2670 on the close. And so now let's take a look at the final disposition of our options trade, and we start analyzing again the trade by acknowledging that we've already booked that $23,390 as we mentioned before. That's positive cash flow, and that's just for starters. And then our broker will do the rest by settling those 2750 puts, which are $79.29 in the money. So you multiply that by 100 per point for a settlement value of $15,858 for those 2 options. Then you also acknowledge that the market closing at 2670.79 means that the 2610 put expires with no value, bringing the total trade profit to over $39,000, which means you more than doubled your money. And so what I'd like you to take away from today's video is that you can enter into put index options trades if you think that the market is getting ready for a tumble. And if you're right very early on in the trade, you can lock down the trade so that you can't lose, as we just illustrated. But by leaving some chips on the table. If your thesis continues to be true, you can make even more with the comfort that once you've locked down those profits, you're in a trade that will yield at least something very positive. And if things continue to go your way, you can make a fortune by scaling out of the trade, as we did here, locking down even more profit, guaranteeing more of a gain regardless of what happens, until finally, if you choose, the options expire. This kind of trade and money management is well known to professional traders, and you now have the knowledge to implement those techniques for yourself if you truly understood this video. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It really is a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through attending this free online workshop. So click the link to sign up now before you miss it.